Good afternoon, everybody. My name is Brian Bosse, and I work at Build & Company. And because it's such a sunny day out, you're going to have a hard time seeing this. So I'll begin by saying we are a subscription-only research service, and we only look at the price of gold. And the reason why we think all of this matters is because it doesn't matter which gold mining project you decide to invest in if you don't get the commodity price right. Flip side, if you get it right, it matters less which one you've chosen to invest in. So you need to have both. We're the only people we know of that only focus on the gold price. We don't tell you what stock to buy. That's not our interest. We only tell you where it can be. Okay? Now, if you're interested in it after hearing what we do, down at the bottom right of the screen it says for a free 2-month trial subscription, please visit www.murenbield.com. Murenbield is one of those last names like Schwarzenegger. It's terrible to spell, it's hard to remember, but as Arnold says, once you remember it, you'll never forget it. Murenbield. So here's what we're going to talk about in the next 20 minutes. We're going to touch on 6 things. I'm going to tell you about who we are and how we came to be. Then we'll go through recent developments. We'll list some of the factors. We'll go through our gold price scenario analysis and the probability weightings we put on each, which then leads us to a forecast. Then we'll talk about something that's on everybody's mind, which is the gold equities don't get the same valuation this year that they did years ago. And finally, after that, we'll talk about one of our proprietary indexes that we're building. Okay, so some of you may recognize the name Murenbield because of Martin Murenbield, who for many years was the chief economist at Dundee Corporation. Does that name ring a bell for anybody? I see some nodding heads. Okay. In the last few years, Dundee has shrunk, and Martin and I and Chantal sitting in the back have gone into business for ourselves. We've taken the high-quality work that we do, we've taken the brand recognition, and we've turned it into a subscription-only business model. We're looking for subscribers. At the moment, we serve the largest mining companies, and we serve the asset managers. We have been doing that for the year and a half since we opened. It's running smoothly. It's running beautifully. What we're working on now, and the reason why we're here today, is we're trying to figure out how to build the right product for the retail market. So we think we have that. We're not going to talk about it here today. We'll just run you through what we do. But if you go to the website and sign up for something, for a subscription, we'll send it to you. It's called Savvy Insights. Okay? All right, recent developments. A new gold bull market started at the beginning of 2016, the end of 2015. And you can see it there with a red arrow. And the supporting line is the large green dotted line. That'll be the very long run line. And then the smaller green line is the current uptrend. And as you can see, the price has made an old high at 1366 and keeps bouncing around right there, right now. Sir, if you join up for the free trial, I'll send you the slide myself. Now, someone's going to ask about why gold is down $30 today. Who wants to ask that question? Sir. Go for an answer if you want. No, it's because of quantitative tightening. Today, the Federal Reserve removed $26 billion from the money supply by allowing bonds that had matured to mature and be turned into cash, returned to the Fed, which draws money out of the economy and out of markets. So almost everything was down today. Gold, of course, being down a little bit more than everything else because it's the anti-Fed, if you will. Okay? All right, so now we'll walk through our outlook. So these are the bullish factors we're going to list in the slide deck. Now, we only have 20 minutes, so we've pulled a few out. But the US dollar, of course, being the world's reserve currency, is the largest factor in the price of gold. We'll go through that in a couple of different ways. The next item is a debt crisis, which in the Western world continues to build. Geopolitical, which is fights about money between countries, which can erupt at any time. The reason why geopolitics matters for gold is because most of the solutions to those fights require the Federal Reserve or the US dollar or the leading country in the world to agree to spend more money, which of course it doesn't have, and that's why the gold price eventually goes higher because of geopolitics. Central bank supply and mining supply. All right, so here's a chart. I hope everyone can see it. This is a very long-term chart of the US dollar. And the one thing we know from history is that of all global reserve currencies, they eventually fall. Someone else takes over. This chart is designed to try and capture that. This is the US dollar index, represented a couple of different ways. We do our own calculation for the basket, which is why you'll see two different colors there, three different colors actually. And you'll see also the vertical shaded lines, those are US recessions. During a recession, money is harder to come by and the dollar rallies because of that. Okay, and what you'll see is over time, this goes back to 1973, over time the dollar has a clear downtrend. Now there are spikes, and you'll see a spike, 1986 or 7? That was, I think, the Washington Accord, where other countries got together and decided that they were going to essentially peg themselves against the dollar. And it was also a time of high interest rates. Okay? At the end there, you'll see a downtrend with a question mark. This is what we think is going to continue to happen. We think that's where we're headed next. Now, I've told you already that our target market for this research is gold miners and asset managers. Some of you may recognize this guy. Anybody know who that is? So Pierre's a happy customer of ours, and here he is at the Franco-Nevada AGM last week using one of our charts with permission. Okay, versus the US economy, every other major economy in the world is running a trade surplus, the US running a trade deficit. So you can see that here, the trade deficit is the blue solid zone, and we divided the world into three parts. First itself, and then China and Japan in the Euro zone. And you'll see that all of them are doing the same thing. They're all saying, we want to run a surplus with the largest consumer in the world. We want to run a surplus with the country that has the reserve currency. They do it because it keeps their people employed, it keeps their economy running, and it's one of the best ways to run trade. Okay, this is an example. Martin's car is a very nice Lexus RX 350. So what we've done is we've taken the Lexus price in all the major trading blocks in the world, and then we've turned it into a percentage, and this is to show you how the trade deficit problem really works. So let's look at the far right-hand column, and we've pegged the percentage to the US to be 100. So we're basing everything off of them. So the same car, which is made in different locations around the world, the same car is 2% more in Canada than it is in the US. And we have an open floating currency, so that's easy to understand. The next is in Japan, that car is 131% of the price it is in the US. Why? It's made there. And the answer is that's why you have a trade deficit. Okay, let's move down the list. In the UK, that car is 150%. In Germany, it's 143%, and in Switzerland, it's 155%. This is the trade deficit. This is what the trade deficit looks like. It happens on almost all products, happens in almost all countries. Any questions about how that works? Okay. Another reason why gold's going to go higher is because what you just saw, this guy is trying to fix it. He's trying to fix it because he knows that's what got him elected. Those votes in the states that we used to call Rust Belt states, I guess they still are, Missouri, Ohio, Pennsylvania, all those places where a decade or two ago people lost their jobs and were told they were going to be retrained. Guess what? They weren't retrained, but they still have votes. And that's what led to what we have. He's got, you like it or you can hate it, but this is what his plan is. He's going to try and solve those trade deficits. Okay? And the only way to solve those trade deficits is to get that percentage gap back down. How do you do that? You lower the value of the US dollar versus the other trading currencies. And if you can't lower it, then you bring in tariffs, which is essentially lowering by another means, which I think we have written out there somewhere. Any questions so far? Okay. The dollar is overvalued. Let's talk about that. This is a graph of the US dollar versus the Chinese renminbi. And if you notice, it goes all the way back to 1981. So right now, when a politician or you and I talk about the value of the Chinese yuan, we usually live within the last little series of bumps on the right-hand side of that graph. But the really important thing to understand is China devalued its currency a heck of a lot before it entered the WTO. So they brought their trading advantage with them into the WTO. And so when they tell you now, or somebody else tells you, well, it's higher than it was when they entered the WTO, or things are changing 5 or 10% one way or the other, 5 or 10% is not what we're talking about. That's not what's going to close the gap. Here's the gap, okay? In addition to all those debt issues that we talked about and the tariff issues, we also have in the Western economies, especially in the US, the demographics of the country are getting older. We're moving past an average age in the 30s, we've gone to the 40s, and now we're getting even farther. So the red line horizontal across here is whether a country has an average age of 30 or higher. That's called super aged. The reason why it's called super aged is because the way we've set up the government spending, once you reach 65, the government hands you money. Entitlements along the way. So if that number is continually growing, which it is, and you can see it across all the decades to come, then we run into this problem. And the top line there on the graph, this is how the U.S. government spends its money. And you can see our source down in the bottom is the Bureau of Economic Analysis, so it comes from the U.S. federal government. The growing portion is entitlements, and as people get older, that entitlements line will accelerate to the upside. So a lot of this crisis is already baked in. It's coming. You can't avoid it. All you can do is maybe means test the results. Okay, and if we look down at what's declining, defense is declining as a percentage of the budget. Interest on debt is declining as a percentage of the budget, but a lot of that is because interest rates are so low. If interest rates turn, that number is going to have to rise. Now, I consider this to be a side debate, but there is a side debate about whether rates will truly rise to where they need to be because the Fed is owned by the government and the government is the one that will have to pay the higher rates. I don't get into that, okay? We just study with the facts as we can see them. And then other. Other is everything else. Building highways, building bridges, supporting new technologies, all of that stuff, immigration is all in the other column. So this really shows you how much of this is built in already. You can't turn off entitlements. No politician can turn off entitlements, and that'll come up later. Okay, and not only in the US, but you'll see it all over the Western countries. So this line, a horizontal line here, represents where debt of the country is 90% of the GDP of the country. The concept being that you'd have to work all year to pay off your debts. There's a landmark study from the year 2010, if memory serves, by two guys named Reinhardt and Rogoff. And they go back through history and they look at all the situations where a company has almost as much debt as it has income and what happens to that economy over the next 10 years. Well, eventually they have to turn towards paying off that debt because there is a limit to how much you can carry, and that turning to pay it off slows down the underlying economy. And we can see we're now at or beyond that number almost everywhere in the West. So what will governments do? They have really two choices. They can have the top end, which is to continue with these policies because all the solutions are hard, and you won't get reelected if you pursue those solutions. So that's more monetary easing, relatively speaking, expansive fiscal policies, devaluation, and financial repression, including tariffs. The other way is to cut entitlements by passing laws to say we're going to hand out less money, raise taxes, and then accept whatever comes to essentially cleanse. And that's not going to happen. There's no politician, even Trump, is going to gear up for that. So we're going to remain with the top set of choices, and that's going to keep us on the path that we are towards higher gold prices. Geopolitics, I'm going to skip because we only have a 20 minutes window here. However, any of these things could happen. North Korea is currently pieces breaking out in North Korea, but that's happened before and never seems to last. So we'll see where that goes. This is the largest recorded geopolitics event on gold. This is when gold doubled off the Iranian hostage crisis and Russia going into Afghanistan. So for us, this is one of the key reasons why you want to subscribe to us. We will tell you what the term premium is at the moment for geopolitics in the gold price. Can't get that anywhere else. I think everybody knows that. Bearish factors. So Fed fund rate hikes don't really change the price of gold. What really matters for the price of gold is the real interest rate. And our studies show that the real interest rate has to be above 1% before you really get into any issues for the gold price. We're not there now, and at the rate we're increasing, we won't be there for at least 3 or 4 more years. Central bank balance sheets are starting to tighten. Remember, we talked about $30 down today. That is something that happened today. It was known in advance on May 15th. The next one is May 31st, and the one after that is June 30th. Those are the dates at which the Fed's pulling money out by not rolling over those bonds as they mature. Gold competes with equities. Equities are doing great. So a generalist investor would rather put their money into equities. That changes. It's a cycle. Update scenarios. Scenario A is our bearish case. Scenario B is things go sideways. Scenario C is things are going to work out according to our bullish plans, and then we weight them 15, 60, 25. That brings you down to the weighted averages, and then we add in a geopolitics number, and that brings you to our finals. So in 2019, we think gold will average $1,450. Okay, this is really interesting for gold equity investors. This chart goes back to 1984. All we've done is we've taken the value of the TSX Gold Index. We've divided that value by the price of gold. What we're trying to get here is a demonstration of how much an equity buyer wants to pay for an ounce of gold in the company that they're buying. Any questions? I know it's as if you took the price of American Barrick and divided it by the gold price, and you'd essentially get the valuation per ounce that an equity buyer is willing to pay. So what you'll see is from 1984 all the way through to 2008, that number is rising. And then from 2009 down to 2018 and continuing, the relationship has changed. People are willing to pay less for an ounce of gold in a mining company. Now, the question is why? We don't have time to get in, but I'll label 3 of them right just off the top. ETFs, royalties, and crypto. There's just 3 quick ones, and we'll move on. Same thing on the US index. In a dark room, this would look really great. It's from a restaurant where we were working out one of our proprietary indexes. So this is our index that describes whether mining companies can raise money today or not. Just take a second to look at it. We've got the mining finance window wide open on the top bar, which is gold colored. The middle section, which contains most of the observations. And then down at the bottom, the red zone where the window for financing is mostly closed. At that point, only the best projects with repeat management teams and past successes can raise cash. Okay? I'll go through this pretty quick, but this is essentially how we've done the math. We've put this out to our readers over a month ago and asked for feedback. We've received feedback from more than half a dozen corporations and asset managers, and I think we're ready to roll out this index, and we would include it in our Savvy Insights for those of you who wish to subscribe for free. Other things we're going to bring out in the near future. A generalist investor index. This comes from a conversation I had with the CEO of Agnico Eagle a couple of weeks ago, Sean Boyd. He was trying to figure out how long this gold cycle is going to last. He said, quote, "By the time the generalists are in, it's usually over." I said, what if I could show you how to tell? He said, I would pay for that. So now we're building an index to track against history how far the generalists are into the cycle. Okay? Thank you very much. For a free trial, please go to our website.